Good morning, everybody. Welcome to the Reserve Bank and to our June monetary policy statements. I'm Alan Bollard. The Reserve Bank this morning is increasing the official cash rate. We're increasing it by 25 basis points to 2.75%. And that's marked by the fact that this economy has now entered the second year of its recovery, and we note that growth is becoming more broad-based. Looking internationally, we've seen a recovery in our trading partner economies continuing. We're noting that growth in Asia has been particularly strong, and that with ongoing growth in Australia and more recovery in the United States, this is offsetting the weaker growth that we've been seeing in some other markets. Overall, this has been contributing to the fact that our export commodity prices have been increasing sharply in recent months, and that means that export incomes have been going up as well. And in contrast to the stronger economic story, we do note, of course, the renewed turmoil in some financial markets. The main pressure that this is exerting on New Zealand is via continuing pressure on the cost of funds to the banking system. For the New Zealand economy, we forecast something around 3.5% growth this year and next year. The main drivers, they're export prices and export volumes, strong, an improving story in the labour market, and a pickup in residential and business investment. But despite that, we do expect to see households continuing to stay relatively cautious, with housing and credit quite subdued. This moderate housing spending, of course, has its other side, because it does imply that there is some rebalancing going on in the economy. The underlying CPI inflation is expected to track within the target range over the period, even as the economy expands further. We do, however, note that headline CPI inflation will be boosted temporarily by the increase in GST and by some of the other increases in government charges that have been announced. Provided that households and businesses don't reflect this inflationary spike into their own wage and price-setting behaviours, then we do not expect to see lasting impacts on inflation in New Zealand. And as an outcome of this, and indeed as we've been signalling now for some time, we've decided to begin to remove some of the monetary policy stimulus that is currently in place. Further removal of stimulus will be constantly reviewed in light of ongoing economic and financial developments. We note a number of things about the forward track in interest rates. Bank funding costs are higher. Long-term interest rates look higher than short-term rates. And we've got a greater proportion of New Zealand borrowers using floating rate mortgages than in the past. And for these reasons, this should limit the extent to which the OCR needs to increase in this cycle compared to previous cycles. Ladies and gentlemen, thank you. We're open for questions, and to assist, John McDermott, Chief Economist, Assistant Governor, and Dean Ford, Head of Forecasting. Thank you. Any questions?
Dr. Bollard, how worried are you about inflation expectations, given what inflation has done over the last 5 years and the fact that you're looking at a spike to something north of 5% in the year ahead?
Well, I guess we'd make a distinction between underlying inflation, and the story there, of course, has been the global crisis and contraction around the world, and in New Zealand has meant that that has reduced pressures there, but we do note that in a number of countries that underlying inflation pressure has come off a bit, but not hugely. So some of that's still there. Secondly, Of course, then you've got the GST and other price charge effects, which are a hike on top of that. We do take a fairly benign view of this at this stage, which is that people will look through those effects. They'll see them for what they are. They're one-off, and we don't expect them to have a lasting impact through onto changes in behaviour. If we saw that happening, then our monetary policy response would have to be harsher than the one that's here in this statement.
Dr. Bollard, you say that interest rates may not need to go up as much as in the past. Can you give an indication of how far you think neutral is? How much is the rise likely to be compared with previous cycles?
Well, currently we see ourselves as easing our collective foot off the accelerator, but for the next little while we'll still be in very stimulatory monetary conditions, and that's going to be the main feature of monetary policy for some time, the rate at which we remove stimulus from the economy. We haven't planned out particular levels. We don't have a specific view about what the new neutral rate might be. That's ultimately going to depend on people's behaviour, on households' behaviour and on businesses' behaviour. We're going to be observing that incrementally. We're hopeful that we won't have to go into heavy foot on the brake. That's still some way off, and we've got a lot of time to judge that. But we have to say that people have changed behaviours after they've gone through the crisis. We'll be watching how much that's an enduring change or how much it's a transitional change, and that would impact where ultimately those neutral rates would be.
Can you tell me, please, how the Reserve Bank feels the economic problems in Europe, how much they contributed to this decision today?
Well, we've obviously been watching quite closely what's been happening on the financial markets in Europe. I mean, currently it's more a financial story than an economic story. It's been a very difficult financial story for Europe. We're obviously watching how much that spreads, what sort of impact it could have here. So far, our view is that it contributes to the general volatility in financial markets, and that contributes to the continued strong, the high cost for funds broadly, but it's not having a worse impact than that at the moment. However, these things can change, and we'll stay alert to them. Would it have much impact on New Zealand trade? Well, currently we don't think so. New Zealand trade exposure into Europe is quite limited. It's less than 10% of our exports. Most of that goes to Northern Europe, which is actually in good shape, as opposed to Southern Europe, which is in poorer shape. We're not hearing of problems on those stories yet. Some of those Southern European economies are going to have a very difficult time adjusting and pulling back government spending. That won't apply right across the board in Europe. Some countries in Europe will be able to enjoy more competitive exporting conditions. So there's a lot of pluses and minuses in all of that. But above all, we have to keep watching the volatility. We will keep doing that. It's the sort of thing we will look at as we go forward on this monetary policy track.
Dr. Bollard, just to follow up, the 90-day interest rate track suggests about 300 basis points of rise over the next couple of years. What sort of impact do you expect that to have on household incomes and I guess the housing market as well?